It wasn't a trade dispute, it wasn't a geopolitical signal. It wasn't even a tactical repositioning, it was a structural liquidation. The numbers are absolute, the arithmetic is merciless. When a sovereign creditor begins to exit the debt of a hegemonic power, the timeline shifts. It shifts from decades to months. We look at the headlines and see politics, we see tariffs, we see summits. But the ledger sees something else entirely. It sees the end of an exorbitant privilege. It sees the closing of a cycle that has run for 80 years. China dumping $53 billion in U.S. Treasuries is not a warning shot, it is a margin call. And history shows us exactly how this margin call gets paid. It gets paid in purchasing power, it gets paid in social stability. It gets paid in the dissolution of the middle class. The pattern is unmistakable. We have seen this specific sequence of events before. We saw it in the 16th century when the Genoese bankers pulled the plug on the Spanish Habsburgs. We saw it in the 1920s when the French drained gold from the Weimar Republic, and most terrifying of all, we saw it in 1931. If that is the year the British Empire effectively died financially, not on the battlefield, not in Parliament, but on the balance sheet of the Bank of England. Foreign holders sold sterling, they demanded gold. And the British government faced a choice that broke the world. They could defend the currency and crush their economy, or they could print default and devalue. They chose the latter. And the world burned for 15 years. The current data suggest we are standing at that exact threshold again. The scale is different, the speed is faster, but the mechanics are identical. The incentive is to sell before the crowd, the payoff is survival, the risk is being the last one. Holding the paper under these constraints, the rational move is to exit. China is exiting. And just like 1931, the domestic population is unaware that the ground beneath them has already liquefied. This isn't about one country, it is about the life cycle of imperial debt. It follows a physics as rigid as gravity. Empires are built on credit. They are sustained by confidence, and they die when the cost of servicing that debt exceeds the plunder of expansion. We will look at 3 specific historical case studies to prove this. We will examine the Spanish Empire, the British Empire, and the Weimar Republic. In each case, we will see the same trajectory: peak dominance, unsustainable costs, the chosen monetary shortcut, the resulting inflation, the flight into hard assets, and finally the social fracture that leaves the middle class priced out of existence. We will then map these 7 distinct stages onto the present day. We will see where we stand in the sequence, and we will look at the only 3 ways this ends: controlled decline, chaotic collapse, or a total reset. The only variable is timing and pain. To understand the gravity of a $53 billion sell-off in the modern era, we must first understand the architecture of the collapse that defined the early modern world. We begin with the Spanish Empire in the 16th and 17th centuries. This was the first truly global superpower and empire on which the sun never set, fueled by the most potent monetary injection in history. The silver of the Americas, from the mines of Potosi in present-day Bolivia and Zacatecas in Mexico, a river of silver, flowed into Seville. It was wealth beyond the comprehension of the medieval mind. It was supposed to make Spain invincible. It was supposed to guarantee the dominance of the Habsburg monarchy for 1,000 years. But it did the exact opposite. It hollowed out the productive capacity of the nation and replaced it with financialization and debt. The mechanism of destruction was the asunto. These were short-term loan contracts signed by the Spanish crown with foreign bankers, first the Germans like the Fuggers and Welsers, and later the Genoese. The crown needed immediate cash to pay for its endless wars in Flanders, Italy, and against the Ottomans. The silver fleets took months or years to arrive. The soldiers needed to be paid today. So the king borrowed gold today and pledged the future silver of the Americas as collateral. The incentive for the bankers was clear: high interest rates and political leverage. The incentive for the crown was survival, but the arithmetic was flawed. The cost of the wars grew exponentially, while the silver inflows, though massive, were erratic. By the mid-16th century, the interest payments on the debt began to consume the entirety of the incoming revenue. Think of the Spanish peasant or the small merchant in Castile. During this time, we have records from the era describing the bewilderment of the common man. A shoemaker in Valladolid saw the price of leather double, then triple. Wheat, the staple of life, became a luxury good. This was the price revolution. The influx of silver devalued the currency, but because the crown was using that silver to pay foreign creditors and fund foreign wars, the domestic economy was starved of capital while simultaneously drowning in inflation. The climax of this stage came with the serial defaults of Philip II. In 1557, 1560, 1575, and 1596, the Spanish crown declared bankruptcy. They simply stopped paying. They converted the short-term high-interest Asiantos into long-term low-interest juros or government bonds. This was the first great bail-in of history. The bankers were forced to take a haircut, but the real pain was felt by the Spanish population. When the crown defaulted, credit froze. The merchant in Seville could not borrow to buy inventory. The wool trade in Segovia collapsed because the currency was untrusted. The soldiers in Flanders, unpaid for months, mutinied and sacked cities. Destroying the very empire they were hired to protect. The flight to hard assets was immediate. Those with capital stopped investing in productive enterprises like cloth manufacturing or agriculture. Instead, they bought land, they bought titles of nobility. They bought positions in the church. They sought anything that could not be inflated away or seized by a desperate monarch. The result was a society of extreme stratification. By the early 17th century, Spain was a nation of beggars and grandees. The productive middle class had been wiped out by inflation and tax burdens designed to service the unpayable debt. The empire remained on the map for another century, but it was a zombie. The financial heart had stopped beating the moment the foreign creditors realized the silver was already spent before it arrived. Just like the Spanish Empire, the British Empire in the early 20th century found itself trapped between the memory of dominance and the reality of bankruptcy. This brings us to our second case study and the most direct parallel to our current situation, the collapse of 1931. Britain emerged from World War I technically a victor, but financially shattered. To finance the war, Britain had liquidated its foreign investments and borrowed heavily from the United States. The City of London, once the undisputed banker of the world, was now a debtor. But the psychological adjustment had not yet happened. The British elite believed that to restore global order, they had to restore the pound sterling to its pre-war glory. In 1925, Winston Churchill, then Chancellor of the Exchequer, made the fateful decision to return Britain to the gold standard at the pre-war parity of $486. It was a decision driven by pride, not arithmetic. At that exchange rate, British exports were too expensive for the world to buy. Coal, steel, and textiles, the backbone of the British industrial economy, became uncompetitive. The result was a depression in the industrial north of England that started years before the crash of 1929, but the financial engineering in London masked the rot. The Bank of England, led by Montague Norman, tried to maintain the illusion of solvency by keeping interest rates high enough to attract foreign capital. They needed foreign money, specifically French and American money, to stay in London to prop up the reserves. This is where the parallel to the modern Treasury market becomes terrifyingly precise. By the summer of 1931, the world was in the grip of the Great Depression. Austria's largest bank, Creditanstalt, had collapsed. Panic was spreading across Europe. Foreign central banks and private investors began to look at Britain's balance sheet with fresh eyes. They saw a nation with declining exports, rising budget deficits, and a massive overhang of short-term debt owed to foreigners. The smart money began to move. In July 1931, the drain of gold from the Bank of England accelerated. The French, sensing weakness, began converting their sterling balances into gold bars and repatriating them to Paris. It was a run on the bank, but the bank was a sovereign nation. The breaking point was not a boardroom decision, but a social one. In September 1931, the British government announced pay cuts for public sector workers, including the Navy, to try and balance the budget and appease the foreign creditors. The sailors of the Atlantic Fleet at Invergordon refused to obey orders. It was a polite mutiny. There was no violence, but the signal was catastrophic. The news that the British Navy, the ultimate guarantor of global security, was mutinying over pay flashed across the telex machines of the world. The illusion of stability shattered. The selling turned into a deluge. In a matter of days, the Bank of England burned through its remaining reserves. On September 19, 1931, the bank was forced to suspend gold payments. Britain defaulted on its promise to pay gold for paper. The pound collapsed, losing 25% of its value almost overnight. Consider the life of a clerk in London during that week. He had been told his entire life that the pound was as good as gold. He had saved in government bonds. He had trusted the institutions. Over the weekend, the value of his savings in international terms vanished. The cost of imported Goods, bread, tea, meat spiked. The middle class, which relied on fixed incomes and savings, saw their security evaporate. The flight to assets in 1930s Britain took a different form than in Spain. It was a flight to tangible survival. People hoarded goods. The wealthy moved capital to New York or Switzerland if they could get it out in time, but for the majority there was no escape. The sterling area was formed a closed trading bloc that tried to ignore the outside world, but the era of British global financial dominance was over. The scepter had passed not by negotiation but by the brutal arithmetic of a margin call. Just like the British Empire, the Weimar Republic demonstrates what happens when the debt is denominated in a currency you can print, but the obligation is real. While Britain tried to deflate to save the currency, Germany in the early 1920s took the opposite path, the Weimar. Hyperinflation is often misunderstood as simply printing too much money, but the root cause was the structure of foreign debt. The Treaty of Versailles imposed reparations on Germany that were denominated in gold marks. Germany could not print gold, they had to earn it through exports or borrow it. When the French occupied the Ruhr industrial region in 1923 to extract unpaid reparations, the German government ordered a policy of passive resistance. They told the workers to strike. To pay the striking workers, the government printed paper. Marx, the dynamic that followed, is the ultimate lesson in the velocity of money. Initially, the population didn't realize what was happening. A university professor in Berlin might have noticed prices rising, but he assumed it was temporary. He kept his savings in the bank. He held his government bonds, but the foreign exchange markets knew better. Speculators in Amsterdam and Zurich began shorting the mark relentlessly. As the currency fell internationally, the cost of imports skyrocketed. This fed back into domestic prices. Then came the psychological break. It is the moment when the population realizes the money is the problem. We have diaries from the era describing the frantic behavior of ordinary people. A worker would get paid at 1100 a.m. and rush to the nearest shop to buy anything, a piano, a sack of coal, a painting, because by 100 p.m. the money would be worth half as much. The flight to hard assets was total. The most valuable things in Germany became foreign currency, gold and land, but also tangible goods. The middle class was liquidated. A lifetime of savings could not buy a cup of coffee. The professor who had saved for 40 years found himself destitute, while the speculator who had borrowed money to buy a farm became a king, paying off his debt with worthless paper. The social fracture was absolute. The middle class, humiliated and impoverished, lost faith in the democratic state. They looked for a savior who would tear up the debt and restore order. They found one. The road from the financial collapse of 1923 led directly to the darkness of 1933. The pattern repeats in 7 distinct stages. Stage 1 is the expansion. The empire or nation enjoys a period of unquestioned dominance. Its currency is the world reserve standard. It can borrow cheaply because the world needs its money to trade. Debt builds up, but it seems manageable because growth is strong. Stage 2 is overreach. The nation commits to obligations it cannot mathematically afford. This could be foreign wars, as with Spain. It could be a welfare state and military dominance, as with Britain, or it could be unpayable reparations and social supports. As with Weimar, the debt begins to grow faster than the economy. Stage 3 is the pivot. This is the critical turning point. Foreign creditors who once bought the debt insatiably begin to lose confidence. They see the deficits. They see the political dysfunction. They start to sell. This is the Treasury dump phase. The nation must now pay higher interest rates to attract capital, which only worsens the deficit. Stage 4 is the currency defense. The government tries to stop the bleeding. They might raise interest rates. They might impose capital controls. They might issue patriotic appeals to buy bonds. In this stage, the leaders will lie. They will say the currency is strong. They will say the banking system is sound. They have no choice. To tell the truth would be to trigger the panic. Stage 5 is inflation and devaluation. The defense fails. The government is forced to choose between defaulting on the debt or printing money to pay it. They almost Always choose to print it is the path of least resistance. The currency loses value against real assets. Prices rise not because goods are scarce, but because the money is broken. Stage 6 is asset flight. The population wakes up. They realize their savings are melting. They rush to exchange currency for anything that will hold value. Real estate, gold, foreign currencies, commodities. The velocity of money explodes. The crack-up boom occurs where the stock market might rise in nominal terms but falls in real value. Stage 7 is social fracture. The inequality gap becomes a canyon. Those who held assets are preserved or enriched. Those who held cash or bonds are destroyed. The middle class ceases to exist as a stabilizing force. Political extremism rises. The social contract is voided. Just like the Spanish, British, and German examples, the United States today is flashing the warning signs of Stage 3 and entering Stage 4. The data is public. The parallels are not theoretical, they are accounting identities. China's sale of $53 billion in treasuries is the modern equivalent of the French selling sterling in 1931. It is a vote of no confidence. But it is not just China. Central banks around the world are buying gold at the fastest pace since 1967. They are looking at the $34 trillion US debt. They are looking at the $1 trillion annual interest payments. The interest on the money it already borrowed. Bitcoin and gold reaching all-time highs are not speculative bubbles, they are alarms sounding in the cockpit. This is the exorbitant privilege. The counterargument is that the U.S. can simply monetize the debt forever because there is no alternative but the incentive. Structure argues against this. This accelerates the inflation, which accelerates the exit. This brings us to the three possible endgames. This is the financial repression scenario. The government keeps interest rates below the rate of inflation for a decade. This was the path of the post-World War II era, but it requires a compliant population and closed capital borders. This is the 1931 or 1923 scenario. A sudden loss of confidence triggers a cascade of selling. The third is reset and restructure. The currency is redefined. Debts are written down or jubilee is declared. A new anchor is chosen, perhaps a basket of commodities, gold, or a new digital ledger. This restores mathematical balance, but wipes out the existing equity of the creditor class. The only variable is timing and pain. The trajectory is set by the debt. The constraints are set by the creditors. The outcome will be determined by who moves first. If you are watching this, you are the resistance to the narrative of transitory problems. You are the student of the pattern. The goal is not to predict the exact day of the break. The goal is to be positioned so that when the break comes, you are not the one holding the empty bag of promises. Subscribe to continue this analysis. Focus your preparation on education, on resilience, and on watching the flow of capital, not the flow of rhetoric. The history books are open. The lesson is clear. The next chapter is already being written.